Hi, I am investing in common sense. I'm going to discuss with you about Maybank, especially the validity of the statement. Increase in OPR will only benefit the banks by Lim Guan Eng, our former finance minister. The relationship between leverage and bank run and Maybank dividend reinvestment plan, which is similar to rights issue, in my personal opinion. Maybank was ranked first in the KLCI index with the market capitalization of 107 billion ringgit on the 25th of December 2023. It is the leader in digital bank in Malaysia with market share of 46.2% and 58.4% respectively in mobile banking and internet banking transaction volume. It is the largest Islamic bank in Malaysia and the fifth largest in the world in terms of asset size. It has 967 retail and 38 investment banking branches in ASEAN. How do banks earn money? There are two sources of income, fund-based income and fee-based income. Fund-based income includes the loans granted to individuals and businesses. For individuals, the banks provide personal loans, mortgage loans, education loans, car loans, and others. For businesses, the loans are similar to individuals but also include working capital loans, equipment financing, invoice financings, and others. The banks fund the loans by taking deposits and introducing money market instruments like certificate of deposits, commercial papers, and repurchase agreements to investors. The banks receive deposits at lower interest rate and lend the loans at higher interest rate. The difference between interest expense and interest income is a profit for banks. For example, an individual puts money into a Maybank fixed deposit account for a period of 1 year for 2.8% interest rate, and Maybank lends a housing loan to another individual at 4.5% interest rate. Maybanks earn 1.7% from the spread, which is called net interest margin. Similarly, the banks can sell the money market instruments to investors at lower interest rate and lends the loan at higher interest rate. This is another hypothetical example. Maybank issue 1.24 ringgit Islamic additional Tier 1 capital securities at 4.08% interest rate to investors, and the proceeds will be utilized as loans for businesses for capital investment purposes for 6.5% interest rate. Maybank earns 2.42% net interest margin. There are two schools of thought on the impacts of the interest rate on the banking industry profitability. On one hand, increasing interest rate will increase banking industry profitability. The reason is that the banks can charge higher interest rate on the loans more quickly than that of deposit rates. This view was supported by our former finance minister Lim Guan Eng. He mentioned that only banks have gained from OPR highs to 3% in May 2023. On the other hand, increasing interest rate will decrease banking industry profitability because the customers like to put money into fixed deposit accounts when interest rate is high, causing net interest margin to drop due to strong competitions between the banks to increase the funding cost to entice the clients. And there is lesser demand for the loans. For example, in the first half of 2023, Malaysian OPR increased to 2.83% from 1.83% in the corresponding period of the previous year. However, Maybank net interest margin dropped to 2.16% from 2.38% during the same period, arising from continued deposit competition. If we analyze the relationship between OPR and Maybank net interest margin, the result is negligible correlations. OPR and Maybank net interest margin does not move in parallel. When OPR increased to 3.25% in 2018 from 3% in the preceding year, the Maybank net interest margin in 2018 did not increase in the same proportion, but maintained at the more or less the same level as when OPR was 3% in 2017. When Bank Negara reduced OPR to the average of 2.1% in 2020 to revive the economy due to COVID-19 from the average of 3.1% in 2019, the Maybank net interest margin decreased marginally from 2.28% in 2019 to 2.1% in 2020. From the examples given, OPR is not the determinant of net interest margins of Maybank. The reasons could be strong deposit competitions. The bank will increase deposit rates eventually to catch up with the OPR. The loans are repaid at lower interest rate. Apart from that, Maybank has non-interest income. To a normal person like us, ATM card fees, loan agreement fees, safety deposit fees, brokerage fees are the most common types of non-interest income. Maybank non-interest incomes includes commission, service charges, and fees like asset management fees, corporate advisory fees, brokerage incomes, fees on loans, advances, and financing. Treasury and market income like trading income and investment income, foreign exchange profit, unrealized and realized gain on financial assets and liabilities and derivatives. Insurance income and others income. Over the 6-year period, non-interest incomes account for 38% of net operating income. The banking industry is tied with monetary policy and largely about leverage. Statutory reserve requirement is enforced by Bank Negara Malaysia to manage money supply. When the inflation is high, Bank Negara can reduce money supply by increasing statutory reserve requirements. The banks need to put more eligible liabilities as reserve in Bank Negara and vice versa. Currently, statutory reserve requirement is 2%, which indicates the banks in Malaysia needs to maintain 2% of eligible liabilities as reserve at Bank Negara, which is interest-free. Eligible liabilities is defined as ringgit-denominated deposits and non-deposit liabilities, net of interbank assets and placements with the bank with additional adjustment. So, what is the relationship between statutory reserve requirements and leverage? For example, when customer A deposits 100 ringgit into a savings account, many banks need to put 2% of 100 ringgit as statutory reserve requirement and lends the remaining amount, which is 98 ringgit. Customer B borrows 98 ringgit from Maybank and spends the money in a restaurant. Then restaurant owners save the money in Maybank. Maybank needs to put 1.96 ringgit as reserve in Bank Negara and lends the remaining amount, which is 96 ringgit. The examples go on and on. In the end, with the initial deposit of 100 ringgit, Maybank can have a total of 5,000 ringgit deposit of 4,900 loan amount to clients and of 100 ringgit as statutory reserve requirements due to the multiplier effect. Customer deposits are a loan for Maybank. Over the years, the leverage ratio of Maybank, which is defined as debt to equity, is 10, which means 90% of assets are financed by debt, while 10% of assets are financed by equity. If everyone is withdrawing money at the same time from Maybank, which is similar to every debtor asking Maybank to repay the loans, then Maybank will collapse. Because Maybank does not have enough funds in the short term. The business model of banking industry is maturity transformation, which means the maturities of customer deposits are short term, while that of loans are long term. Maybank has a dividend reinvestment plan, which is similar to rights issue in my personal opinion. The difference is that the shares purchased from dividend reinvestment plan is paid by dividend, while the shares from rights issues are the shareholders need to take money out from the pockets to purchase them. For example, Maybank 23rd dividend reinvestment plan, in conjunction with the first interim dividend for financial year ended 31st of December 2022, offer the shareholders to buy a new share at 8.38 ringgit, which was 3.23% discount to the volume-weighted average market price of 8.94 ringgit or 8.66 ringgit after dividend adjustment, up to and including 2nd of September 2022. The dividend was 28 cents, of which 7 cents electable portions could be chosen to reinvest to buy the new shares or receive dividend payment. 21 cents is non-electable portions, which means the shareholders will receive dividend payment only. Assuming shareholder ABC had 10,000 shares with the share price of 8.94 ringgit on the 5th of September 2022, the portfolio value was 89,400 ringgit. I'm showing you three scenarios. In the first scenario, shareholder ABC chose to reinvest the entire portion of electable in new shares. The shareholder will increase 83 additional shares, which was derived from the total number of shares multiplied by electable portion divided by issue price, which is 10,000 multiplied by 7 cents, then divide by 8.38 ringgit, and the total amount of shares will increase to 10,083. The theoretical portfolio value will be the number of total shares multiplied by share price after dividend adjustments plus dividend from non-electable portions plus dividend from balance from the electable portions, which is 10,083 multiplied by 8.66 ringgit plus 2,100 ringgit plus 4.46 ringgit, which is equal to 89,423 ringgit. In the second scenario, the shareholder choose to reinvest the partial portions of electable, let's say 30 new shares. The theoretical portfolio value will be 10,030 multiplied by 8.66 ringgit plus 2,100 ringgit plus 448 ringgit and 60 cents, which is equal to 89,408 ringgit. In the third scenario, the shareholder chooses to reinvest non-electable portion. Then the portfolio value will be 10,000 multiplied by 8.66 ringgit plus 2,100 ringgit plus 700 ringgit, which is equal to 89,400 ringgit. Let us compare the first scenario with the third scenario, which are the shareholder choose to reinvest the entire electable portions and reinvest non-electable portion. The difference in the amount of shares is 83 shares or 0.8%. It is meant that there will be shares dilutions of 0.8% if the shareholder choose not to reinvest the electable portion. This 0.8% might look small, however, over the long term, there is a huge difference. From 2017 to 2022, the number of shares increased 11.79% from 10 billion 782 million to 12 million, of which 1.097 billion or 10.18% was attributable to the new shares issued under the dividend reinvestment plan. Therefore, if the shareholders choose not to reinvest any electable portions since 2017 until 2022, there will be dilutive effect of 9.24% due to not to reinvest any electable portions under the dividend reinvestment plan. If we divide 8.234 billion ringgit net income to equity shareholders in 2022 by the shares issues of 10.782 billion in 2017, the earning per share was 0.7637 ringgit compared to 0.6932 ringgit using the total of new shares issued from dividend reinvestment plan from 2018 to 2022 plus the number of shares in 2017. The difference between 0.6932 ringgit and 0.7637 ringgit is 9.24%, which is also the dilutive effect for the shareholder. Choose not to reinvest any electable portions of dividends since 2017. Maybank growth rate is rather stagnant. Operating revenue grew at a 5-year CAGR of 2.2%, operating profit at 4%, net profit at 1.4% from 2017 to 2022. Maybank return on equity ranged from 7.68% and 10.77% over the 6-year period. The particularly low return on equity in 2020 was due to the management foresaw potential deteriorating asset quality owing to COVID-19 pandemic and hence double the allowances for impairment losses on loans, advances, financing, and other debts to 4.59 billion ringgit. However, return on equity is not the best methodology to measure the profitability of banks because this is a measure for the returns of shareholders. A better formula is return on Tier 1 capital. Tier 1 capital is the core capital amount for bank business. I define return on Tier 1 capital as operating profit divided by Tier 1 capital. Over the years, Maybank return on Tier 1 capital ranged from 13.06% to 18.04%. If the number was around 13%, it indicated Maybank could generate 13 cents operating for profit out of 1 ringgit capital. Operating profit is used to make sure the comparability and avoid the differences in tax treatments and non-core earnings like share of profits in associates and joint venture. Over the 6-year period, the net interest margin produced by Maybank ranged from 2.1% and 2.39%. The cost-to-income ratio was around 47% during the same period. Maybank loan-to-deposit ratio stood at around 87% during the same period, which indicates the liquidity risk was acceptable because it was under 100%. The loan-to-deposit ratio greater than 100% indicates a decline in deposit or a significant loan default could threaten the viability of a bank, or the bank needs to borrow money to lend the loans, and hence lower net interest margin. If the ratio is too low, the bank might have opportunity cost because the deposit sitting there without interest income. The banks need to maintain a proper ratio to maximize income potential. The liquidity coverage ratio issued by Bank Negara Malaysia on the 25th of August 2016 is to measure whether the banks can withstand serious liquidity stress scenario over a 30-day period. Anything above 100% is considered good. The average 6-year liquidity coverage ratio was 138%. It was meant that Maybank had enough high-quality liquid assets to fulfill liquidity requirements for the next 30 days. Net stable funding ratio is another liquidity ratio issued by Bank Negara that complements with liquidity coverage ratio to measure liquidity risk for a period of 1 year. Anything above 100% is considered good. The average 3-year net stable funding ratio was 115% for Maybank. It was meant that Maybank had enough funding to meet assets and off-balance sheet activities for a year. Capital adequacy ratio compares a bank capitals against risk-weighted assets. The purpose is to measure whether a bank has enough funds to cover losses and remain sovereign under difficult financial times. There are 3 capital adequacy ratios, which are Common Equity Tier 1, Tier 1 capital, and total capital. The banks need to maintain 4.5%, 6%, and 8% of respective ratios against risk-weighted assets. As Maybank had an average of 15.43%, Common Equity Tier 1 ratio, 16.36% total Tier 1 capital ratio, 19.18% total capital ratio. Maybank was relatively stable from the solvency point of view. The asset quality indicators are loan loss coverage, gross impaired loan, and net charge-off. The gross impaired loan ratio was declining from 2.34% in 2017 to 1.57% in 2022. It indicated that Maybank had low percentage of non-performing loans out of total loans. The client quality was improving. As I mentioned before, in 2020, Maybank doubled the allowances for impairment losses on loans, advances, financings, and other debts, and hence the net credit charge-off rate jumped to 0.88%, causing the loan loss coverage improve substantially to 98.62% and thereafter. Therefore, Maybank has set aside enough funds to cover non-performing loans starting from 2020. In the Journal of Bank Valuation Models, a comparative analysis, Professor Chitra Gunshankar Gowder and Dr. M. Venkateswalu discussed that residual income valuation model was more superior to value a bank equity value compared to relative valuation model like PE and PB in the context of Indian banks. There was a positive significant relationship between the intrinsic value of banks determined by residual income valuation models and market price of shares in all the cases, including Indian private sector banks, Indian public sector banks, and commercial banks by performing correlation and regression studies. I am using single-stage residual income valuation instead of multi-stage residual income valuation to value Maybank because it had a lag of growth, as I mentioned before. The formula of single-stage residual income valuation is book value plus return on equity minus cost of equity divided by cost of equity minus terminal growth rate multiplied by book value. In the third quarter of 2023 quarterly report, the book value was 7.56 ringgit. The cost of equity is 10% as the growth rate is low in the recent years. 6-year ROE is 9.64%, which is not impressive. Banking industry is highly level. The terminal growth rate is 2.5%, which is the average of the CAGR of revenue, operating profit and net income. Valuation deriving from residual income valuation is 7.19 ringgit. The fundamental driver is return on equity for residual income valuations. Since Maybank ROE is lower than cost of equity, and hence the valuation derived from residual income valuation is lower than book value. If anyone is interested in learning stock analysis, please contact me by my email. My email address is in the description. I passed CFA program in 2 years and achieved a distinction for my master degree in finance, investment, and risk from University of Kent. I'm also building financial models for companies. If any company is interested, please contact me by my email.